Imagine if you had a simple yet powerful tool that could tell you exactly when to buy and when to sell. No guessing, no emotions, just pure logic. One of the most popular strategies traders swear by is the Exponential Moving Average, EMA, crossover. But here's the million-dollar question. Can you actually beat the market using only an EMA crossover? Or is it just another trading myth? Today, we're breaking it all down, with real backtests, market data, and historical insights. Let's dive in. The Exponential Moving Average, EMA, is a technical indicator used in trading to smooth out price fluctuations and highlight trends. First, let's quickly understand what an EMA crossover is. A shorter-term EMA, like the 10-day EMA, reacts faster to price changes. A longer-term EMA, like the 50-day EMA, moves slower, capturing long-term trends. The strategy is simple. When the fast EMA crosses above the slow EMA, buy. When the fast EMA crosses below the slow EMA, sell. Traders believe this helps them catch trends early and avoid big losses. But does it really work? We're putting it to the test on the S&P 500, using different EMA crossover strategies in different market periods. Our first test takes us through one of the hardest decades for investors. We faced the dot-com bubble crash in 2000 and the 2008 financial crisis, a brutal time for buy and hold investors. Here's how the EMA strategies performed during this period. EMA 50-100s performed best, plus 32.02%, while buy and hold struggled the most, minus 23.38%. Longer EMAs handled volatility better, while shorter EMAs, 10-20, reduced losses but still underperformed. Conclusion? In a choppy, bear market, longer EMAs helped reduce drawdowns and protected us from holding through deep crashes. For example, in 2000, the strategy signaled a sell at $137 and a buy back at $92, reducing the drawdown by 32.8%. Similarly, in 2007, it triggered a sell at $141 and a buy at $95, cutting the drawdown by 32.6%. These signals helped manage risk and avoid major downturns. But can this approach still outperform in a strong bull market? From 2010 to 2020, the market experienced one of the longest and strongest bull runs in history, steadily climbing after the financial crisis. Let's see how the EMA strategies fared during this time. Buy and hold dominated with a plus 184% return, far surpassing all EMA strategies. Longer EMAs performed better, with 50-100s gaining plus 111.54%, but still trailed buy and hold. Shorter EMAs struggled, missing much of the upside. The main issue? EMAs sometimes triggered sell signals during quick recoveries, causing re-entries at higher prices. For example, in 2015, the EMA strategy signaled a sell at $189 on August 24, only to buy back at $205 in November, an 8.5% higher price, locking in losses. Another sell at $194 in January 2016, followed by a buy at $207 in April, led to a 6.7% higher repurchase, reinforcing the downside of reacting too quickly to short-term dips. This highlights a key weakness of trend-following strategies in strong uptrends, lagging behind when the market moves rapidly. So, while EMAs help in volatile times, they can hold you back in relentless bull runs. From 2020 to 2025, the market experienced another strong rally, fueled by economic recovery and massive liquidity. But how did EMA strategies compare? In this bull market, buy and hold dominated, delivering an impressive 80.40% return, far surpassing all EMA strategies. Shorter-term EMAs, 10-20 and 20-50, struggled, returning 65.46% and 41.26%, while longer-term EMAs, 50-100s and 100-200, underperformed even further, with 36.93% and 46.46%, respectively. Unlike the previous decade, EMA strategies sometimes worked in favor of investors. For instance, in June 2020, an EMA signal triggered a buy at $320, followed by a sell at $429 in February 2022, securing gains before a market downturn. However, not all signals were advantageous. In October 2023, the strategy sold at $410 but then re-entered at a higher price of $448 in November, leading to unnecessary losses. This demonstrates how EMAs can help capture profits but may also result in buying back at higher prices after selling too soon. From 2000 to 2025, the market experienced multiple cycles of boom and bust, testing the resilience of different investment strategies. But how did EMA strategies compare over this long-term period? Buy and hold delivered an impressive 302.97% return, turning a $10,000 investment into $40,297. However, after testing multiple EMAs, I introduced the EMA 5200, a strategy that slightly edged out buy and hold with a 307.61% return, growing the same investment to $40,761. Shorter-term EMAs struggled to keep up. The EMA 1020 lagged significantly with just a 92.81% return, while the EMA 2050 performed better at 160.50%. On the other hand, longer-term EMAs like EMA 5100s and EMA 100-200 fared much better, returning 292.56% and 252.09%, respectively. This long-term period proved that longer EMAs could rival or even surpass buy and hold. With EMA 5200 emerging on top, I wondered, could it be the best EMA strategy across all market conditions? In my previous tests, I analyzed moving average strategies on the S&P 500, but this time, I focused on the NASDAQ 100, QQQ. The results reveal something interesting. While buy and hold delivered a strong 359.53% return, turning $10,000 into $45,953, longer-term EMA strategies performed even better. The EMA 5200 strategy led the way, growing the same investment to $80,248, a 702.48% return. The EMA 100-200 followed closely with 692.33%, showing a clear edge over buy and hold. This example highlights a key takeaway: EMA strategies performed better on the NASDAQ 100 than on the S&P 500. We tested various EMA strategies on both the S&P 500, SPY, and NASDAQ 100, QQQ, to compare their long-term effectiveness against buy and hold. Analyzing different market periods from 2000 to 2025, we found key insights into how EMAs perform. Here are the takeaways. EMA strategies reduce drawdowns in bear markets but may underperform during strong, steady bull runs. Longer-term EMAs, 5200 and 100-200, performed best, providing a balance between risk management and returns. NASDAQ 100 responded better to EMA strategies than the S&P 500, likely due to stronger long-term trends in tech stocks. Shorter-term EMAs, 1020, 2050, struggled with false signals, especially in choppy markets. To keep the test fair, the first buy occurred when the short EMA was already above the longer EMA, ensuring proper trend confirmation. Over 2000 to 2025, EMA 5200 slightly outperformed buy and hold on QQQ, showing that moving averages can be a viable long-term strategy in certain markets. If you found this helpful, like, subscribe, and turn on notifications for more market insights. Your support helps us create more data-driven content. Thanks for watching, and see you next time.